and our inventory costing methods. I'm going to kind of go through an abbreviated lecture on this, and I'm going to hopefully be writing a lot of things on the board, and we may need to be looking at things in the book as far as the charts are very important in the book. Get to chapter 5.
215.
Okay. Now, in chapter 4, we talked about the journal entries involved as far as how we get the entire cost for inventory. Do you remember the equation sheet that I handed you out with cost of goods sold, right? So we've got net purchase, beginning inventory plus net purchases minus ending inventory gave us cost of goods sold, right? Now, we're going to go through the different methods of how we actually come up with that number for cost of goods sold, how we come up with that number for net purchases, how we calculate those. Now, recalling the journal entries, we are going to go over, there's 4 methods in the book. Specific unit identification, FIFO, F-I-F-O, otherwise known as first in, first out. LIFO, L-I-F-O, otherwise known as last in, first out. And weighted average. We're only going to go over 3 since I only have less than an hour to conquer this. Okay? So we're going to go over FIFO, first in, first out, compare it to LIFO, last in, first out, and then compare it to weighted average. I'm going to try and write things on the board, but mostly I need you guys looking at the charts in the book. The first chart we need to look at is on page 213. So if you turn to page 213, you will see, I don't know if you could glance down on it real quick while I scratch the top of my head. You will see dates, beginning inventory, purchases, and sales. All the information you need to know to build the charts for cost of goods sold. Now, what I want you to ignore in this chart, for this chapter and this chapter only, we are calculating cost of goods sold. Okay, come on. We are calculating cost of goods. You should just take a picture of it so they can see it when I can't edit this video, can I? Okay, so we are calculating cost of goods sold. Now, back in the charts that you guys just took video of, it had a column that said, you can look down there, units sold at retail. Right? You see that 4th column over? Date, activity, units acquired at cost, and units sold at retail. I want you guys to ignore that sales price in that column, the 130 and the 150. We don't care in this chapter how much it sold for. We only care how much it cost us. That's what we're calculating. How much it cost us, not how much we sold it for. So when you're looking at information like that for, say, a homework problem, I want you to just cross off the sales price, because that confuses a lot of people. Okay, now given that information, now we're going to start to build our chart using FIFO, first in, first out. So FIFO means the first layer of goods purchased is the first units sold. Okay? Now, take a look at the chart on page 215 in your books. First in, first out. When you are constructing these charts in order to calculate cost of goods sold, I want you to fill out these columns just like they are, except ignoring the sales revenue. Okay, this is how you need to construct a chart when you're working on, say, exam 2. Okay, I guarantee you are going to have to answer a question where you are asked, what is the cost of goods sold and ending inventory using one, if not all three of these methods? So looking at the chart, you notice we always begin with the beginning balance. Okay? It doesn't matter which of these three methods we're using, we're always going to begin with the beginning balance and the cost associated with that beginning balance. Then, on August 3rd, you see we purchase 15 more items, right? So now we have 2 layers of inventory. We've got 10 items at a cost of $91 for my beginning inventory layer. And we've got a second layer now, 15 items at $106, at a cost to us of $106. So then, on August 14th, we sell 20 of those items. All this information is gathered from the first chart we looked at. So we have 25 items available for sale, right? That's beginning inventory plus purchases gives us 25 items available for sale. Then we sell 20 of those items. It doesn't matter which exact items we sold. If we say we're using FIFO, what that means is we zero out the earliest layer first. So in this case, 10 of those items come from the beginning inventory layer. We zero out that layer. Then the remaining 10 come from the second layer, at the second layer's cost, leaving us with 5 items remaining, 5 items available for sale, all from the second 106 layer. You guys follow? Questions? You can ask questions. Does that make sense so far? So now, on August 14th, we have, in fact, I would encourage questions if you had any. Okay, but on August 14th, we have 5 items remaining for sale at the $106 layer. Our cost of goods sold, the middle layer, is 10 times the $91, our beginning inventory number, plus 10 times the 106. That's where the $1,970 assigned cost of goods sold for those 20 items that we sold. So now we have 1 layer only available for sale. And on August 17th and August 28th, we add 2 more layers, right? So now we have 3 layers. On August 28th, we have 3 layers of inventory. The 5 at 106, the 20 that we purchased on the 17th, and the 10 that we purchased on the 28th. So on August 31st, when we go to sell 23 items, we zero out that first layer of 5, leaving us with 18 that can be taken care of totally in that second layer of 20. So on August 31st, we have 2 items remaining from the second layer, and the full third layer still intact. We didn't touch that yet. And our cost of goods sold would be the 5 at $106 plus the 18 at $115. Now, a question may ask you, what's total cost of goods sold? That'd be the August 14th number in red plus the August 31st number in red. We have $4,570 in cost of goods sold for those two sales, and we have $1,420 remaining in ending inventory. Those 12 units remaining in ending inventory will become my beginning inventory amount in the next period, but you don't have to worry about that. If you can get this far, you're good for this chapter. Questions on where those numbers are coming from? Okay. Don't necessarily worry about the journal entries at the bottom either. I just want you to understand these charts. That's all I want you to understand from this chapter. So now, we will talk about LIFO on page 216. LIFO means last in, first out, which means the last layers purchased are the first items assumed to be sold. Typically, when I try and explain LIFO, I explain it in terms of dairy products, right? Mm-hmm. So, you guys are both women, so I'm going to assume you do this. Usually it's the men who don't do this. You send them out to get a gallon of milk. What happens? They go out, they grab the first thing they see, and they go and buy it, and it expires tomorrow, okay? I'm assuming all of us, including me, will go in there, shove those things aside, and look for the latest date on the milk, okay? Doesn't really matter, because my kids will go through that milk within 2 days anyway. But still, just in case, I'd like it to last a little while longer, right? So that's the concept behind last in, first out. It assumes no matter what, and again, it doesn't really matter what the real purchase habits are. It assumes that the last items that you brought in for sale are the first items that are sold. Okay? So, looking at the chart on page 216, we see the beginning, the first two entries exactly the same as FIFO, right? We've got our beginning inventory layer, and we've got our first purchase. So now we've got two layers. But what happens now for the sale of the 20 on August 14th is now we look at that last layer, the layer with the 15 items in it. So we zero out that 15 items, and then we take the remaining 5 from the beginning inventory layer. Giving us $2,045 in cost of goods sold for those 20 items. Flip the page back. As opposed to LIFO, where my cost of goods sold was $1,970. The reason why I point that out is because in a regular rising cost market, rising cost environment, right, the cost of items increases. It's inflationary, right? So, the last items you purchased are typically going to be the more expensive. So for companies that use the LIFO method, their cost of goods sold initially, anyway, are going to be higher than for a company that uses the FIFO method. Right? Does that make sense? Okay, so now think of this. Sales revenue minus cost of goods sold gives us gross profit, right? On the income statement, sales revenue minus cost of goods sold gives us gross profit. In this case, let's call gross profit synonymous with net income, our overall net income. We have no other expenses, okay, in a grossly exaggerated world. So, using LIFO, my cost of goods sold is going to be higher than FIFO, right? What does that do to my gross profit or my net income? Higher or lower?
Higher.
Gross profit? If this is higher, my expense is higher.
It would be lower.
Right. My gross profit, my net income's lower. The reason why I point this out is because LIFO is the most commonly used inventory costing method for companies for tax purposes. Right? Because if this is higher and this is lower because of it,
Less taxes.
less taxes are paid. Okay? So LIFO is the most commonly used inventory costing method because you'll wind up paying less taxes on the same amount of money you really make. It's totally legal. Okay? It's a method that's allowed by the IRS. It's only allowed here in the United States, though. It's not allowed in any other country. It's a benefit of living in the United States of America. You can pay less taxes legally sometimes. Okay. So now, August 17th and August 28th, we add 2 more layers, right? Now on August 31st, we've got 3 layers still. They're slightly different than our FIFO layers. So for those 23 items, we're going to zero out that last layer, the 10 items at 119, leaving me with 13 items to take out of that middle layer. Cost of goods sold, $2,685. What's sitting in my ending inventory? 5 of my beginning inventory layer and 7 out of my second layer. Total cost of goods sold, $4,730. Oops, COGS. $4,730. What's sitting in my ending inventory is how much? 1,260. For a total cost of goods sold and ending inventory of $5,990. Why did I do that? Because if you go back to the FIFO page, while the numbers are a little different, these numbers should total up to the same amount because we're trying to account for the same amount of cost. We're just doing it in 2 different methods. So for FIFO, what was my total cost of goods sold? $4,570. And what was left in my ending inventory?
1,420.
For a total of $5,990. So this is a double check for you, okay? If you're doing this problem, you're always accounting for the same amount of cost. You're just doing it a little differently based upon the method provided. Questions so far? It's making sense, right? Hopefully? Okay. So now, let's go on to weighted average. It's a lot different than LIFO and FIFO. Some people find it more difficult, but to me it makes more sense. And so I try to break it down like this. You do not have layers in weighted average. And here's a statement that I want to highlight, so I'm going to say it several times. In weighted average, every time you make a purchase, you compute a new single weighted average value for the cost of inventory. You're only going to have one value for all the items sitting available for sale. But that item has to be recomputed every time you make a purchase. Sales don't affect the weighted average. Only purchases change the cost of my weighted average. So every time you make a purchase, your single value, weighted average value for that inventory is going to change. So let's go through the chart. At the top of page 217. Beginning balance, still the same, 10 units at $91. But now on August 13th, when we purchase 15 units at $106, we've got to come up with a new value. It's no longer $91. It's 91 times the 10 units that cost that much, plus 15 times the $106 we paid for those units, or $2,500 total, divided by the 25 units that I have for sale, to give me a single weighted average price of $100 per unit. No other costs matter. No costs previous to that matter. All 25 units that are available for sale have been assigned a cost of $100 a unit based upon the weighted average calculation. Total cost divided by total units available for sale. Now, on August 14th, it's really simple. I sell my 20 units, and the cost is $100 per unit. $2,000 cost of goods sold. And I've got 5 units left at $100 per unit. The $91 doesn't matter. The $106 doesn't matter. When you compute your weighted average, just cross off everything that doesn't matter. That's where students get the most confused. Then on August 17th, I add 20 units at $115 a unit. So that's a purchase. So I have to compute a new weighted average cost. So I've got 5 units at $100 or $500, plus my 20 units at $115 to give me $2,800 total, divided by the 25 units I have available for sale, or a new single weighted average cost of $112 per unit. The $100 per unit no longer applies. Cross it off. The $115 that we bought the 20 units for no longer applies. Cross it off. We have 25 units available for sale at a weighted average cost of $112 per unit. So now, on August 28th, we purchased 10 units at $119 a unit. So now when we get another purchase, we have to calculate a new weighted average. The $112 will no longer apply. So we've got 25 units at $112 per unit. They do it out in different layers. I'm doing it a little different way. Plus the 10 units at $119 per unit gives us a total cost of $3,990, divided by the 35 units we now have available for sale, gives us a new weighted average cost of $114 per unit. No other costs apply. We're now at $114 per unit. And so on August 31st, all 23 units are considered to have been sold at a cost to us of $114 per unit, leaving us with 12 units at an average cost of $114 per unit. So now, where would you expect weighted average to fall? It's going to fall right in between these two numbers, right? So we've got cost of goods sold of 4622. Should have put it right there. Okay? It falls in between, lower than LIFO, higher than FIFO, because it's an average, right? And we've got ending inventory of 1,368, leaving us with 59.90 accounted for. Questions on those 3 inventory costing methods?
On August 28th, when you do the weighted average, and it shows the 5 at 100 and the 20 at 115.
You can do it that way, but we already know that 5 at 100 and 20 at 115 is equal to $112 per unit.
So you can just do the 25
Yep.
at 112 and the 10 at 119, and
Yep.
it'll be the same?
It'll be the same. In
Okay.
fact, that's the way I explained it, but that's not the way they did it in the book, which I find a little annoying.
Okay.
But
But it equals out the same either
it
way?
equals out the same, because
Okay.
you've already averaged those first 2. Okay, so from that part of the lecture, still have one more piece I need to go over, but from that part of the lecture, you need to understand how to calculate cost of goods sold and ending inventory using those 3 inventory methods, LIFO, FIFO, and weighted average. I don't care about specific unit identification. You need to know what it does to my cost of goods sold. LIFO gives me the highest cost of goods sold, thus the lower net income and lower taxes, right? FIFO gives me the lowest cost of goods sold, higher net income, potentially higher taxes. And weighted average falls right in the middle, hence the arrow. Okay. Questions? All right. You guys are awesome. Maybe I should only have 2 group classes. Okay, that didn't record, right? I gotta watch what I say. All right, so last thing I want you to know, so there's this important part of the chapter, and now we need to account for what's called the lower of cost or market, LCM. LCM equals the lower of cost or market. Now, this is in addition to doing the costing methods. So after you've done LIFO, FIFO, or weighted average, they're typically mutually exclusive, right? You pick one of the methods. You don't do all 3 of them, except maybe in testing purposes. But, so, after you've done all that, there's some cleanup we need to do. Because what happens to inventory, typically? It can get obsolete. It can get stolen.
Damage.
It can get broken, okay? So, you go in, and there's 2 adjustments you need to make. Adjusting entries. Remember adjusting entries? Okay? So for inventory, there's 2 adjusting entries we may need to make. The first one is the lower of cost or market. Basically what that means is inventory should be at your books on what you can, on the lower of what you paid for it, or what you can replace it for. So i.e., if you overpaid your inventory and you can actually get it cheaper now, you need to write it down to market. Hopefully, it's already at the lower of cost or market. Hopefully, you've already paid the best price for it, and you don't have to make an adjustment. Now, there's 3 types of groupings in order to decide whether an adjustment needs to be made or not. And let's look at the example, Exhibit 5.9 on page 220, at the top of page 220. So we have a bike shop here that makes 4 different types of bikes in 2 different groupings. Basically racing cycles and off-road cycles. When we're looking at the lower of cost or market, we can look at making the adjustment individually, which is per item. So in other words, we look at the Roadster. The cost of the Roadster to us was $8,000. Market price for each Roadster is $7,000. Okay? Which one's lower? What I paid for it or what I can replace it for?
What you can replace it for.
Right. So an adjustment's going to have to be made if we're doing this individually. So basically what they did here was they took total cost, 8,000 times 20 units is 160,000 total cost, and total market, 7,000 times 20 units for 140,000. Lower of cost or market for that item would be 140,000. We'd have to write that down. We'd have to write our inventory down by $20,000. There's, of course, an easier way to do that. Per unit, you see there's a $1,000 difference, and you can just take that $1,000 and multiply it by the 20 units, right? Either way, you come up with $20,000 that have to be written down from that inventory. Okay? So my journal entry for that would be a credit to inventory, right? I'm decreasing my inventory and I am debiting the inventory expense account called cost of goods sold. That's to write down those cycles for the $20,000 difference between market and cost. Now, let's take a look at the second item, the sprint. Look at the cost, look at the market. My question to you is, does an adjustment have to be made? Is cost lower than market?
Yes.
Yes. And it's already on my books at cost, right?
Yeah.
Does an adjustment have to be made? No.
No.
It's it's on my books at cost. If cost is lower than market, no adjustment needs to be made. The only time that an adjustment needs to be made is when market is lower than cost.
Because then you're accounting for more than you should be.
Then you've overpaid for your inventory, essentially. And using the realization principle in accounting, you need to lower your inventory to market value.
Right.
So the only time you need to make an adjustment using LCM is when the market price is lower than your cost. The only time you need to make an adjustment is when